Welcome back to Investing Talk podcast.
Today we're looking at Intel.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. I think the core idea we're seeing is that Intel is, well, it's at a very early stage recovery.
Right. There's a clear path forward, but it's not going to be easy.
Exactly. You have this really exciting long-term potential, but you have to balance that against, the immediate pain. The cost of this massive Foundry build-out is just huge.
It's a classic high-risk, high-reward situation.
For sure. And I think the first real piece of evidence that this turnaround might actually be working came in their third quarter 2025 results.
That really felt like a turning point, didn't it? The moment the market started to really believe them.
It was a very strong quarter. It validated a lot of what management's been promising. They reported revenue of $13.7 billion.
And crucially, that was a return to year-over-year growth, right?
Yes. And it also comfortably beat their own guidance. And if you look at profitability, operating profit hit $4.1 billion.
Now, hold on. That number had some one-time gains in it, didn't it?
It did, so you have to be careful. It's not all pure operating strength just yet, but it still marks a clear return to being profitable. And their non-GAAP EPS also beat what analysts were expecting.
Okay, so let's unpack where that strength is actually coming from. Was it just one single division carrying all the weight?
No, and that's the encouraging part, really. The strength was pretty broad. If we start with their core business, the client computing group.
CCG, the PC business, basically.
Right, their PC business.
Yeah.
CCG revenue came in at $8.5 billion, which was up a very solid 5% from the year before.
So what's driving that? Is it just that people are buying more computers again?
Well, that's where it gets really interesting for their margins. It wasn't just about higher volume. It was what they call a richer mix.
A richer mix?
Yeah.
Meaning more expensive chips.
Exactly. They're selling more of their higher-priced, higher-margin products, the premium stuff. And that richer mix is absolutely essential for the margin recovery of the whole company.
Okay, that makes sense. But what about the data center? That's really the future, isn't it?
It is. The data center and AI segment, or DCAI, is the one everyone is watching. Revenue there was $4.1 billion.
And how did that compare?
The year-over-year number is a bit complex, but sequentially it was up a strong 5%. And that jump was driven by, well, two main things.
Let me guess. AI.
AI is one, for sure. The ongoing AI infrastructure refresh,
Yeah.
but also the adoption of their new Xeon 6 product.
So if Q3 was that strong, what did they signal for Q4? Are they expecting some huge holiday sales boom?
Their guidance for Q4 is for revenue between $12.8 and $13.8 billion. That's actually seen as a bit seasonally softer.
Okay, so why is that?
This is the critical takeaway. Management framed this not as a demand problem, but as a capacity problem.
Wait, let me get this straight. They're saying they could sell more chips if they could just make more chips.
Precisely. They said, and this is a quote, "The demand is outpacing supply." And they expect that to stay the case well into 2026.
Into 2026? Wow. That's a huge shift in the narrative for them.
It's a massive shift. For years, the story was about losing market share. Now it's about having products that are so in demand that their sales are literally limited by the speed of their factories.
So this execution discipline we're seeing, it's not just a one-off thing.
It seems not. The sources all highlight that this is now 4 consecutive quarters of improved execution and results that were stronger than expected. That consistency is what starts to shift the whole earnings revision cycle.
And that momentum really sets the stage for the much bigger long-term story.
It does. It's not just about selling more CPUs anymore. It's about a total shift in their competitive moat. They're moving from just relying on their old x86 dominance to a new advantage based on manufacturing and their whole ecosystem.
Which brings us to the Foundry Services business, or IFS. Why is that suddenly so important?
Because of two huge trends happening at the same time. First, just an unbelievable global need for more wafer capacity. Everyone needs more chips.
Okay, that one's pretty obvious. What's the second trend?
The second, and maybe even more important one, is the demand for advanced packaging services. Things like their EIBT technology.
Let's pause there because advanced packaging sounds like pure jargon to a lot of people. Why does it matter so much?
Think of it this way. If a wafer is the brain, the packaging is the nervous system connecting it all. You can't fit everything on one piece of silicon anymore.
So you have to stitch smaller pieces together.
Exactly. Advanced packaging lets you take these little specialized chiplets, computing, memory, I/O, and connect them super closely into one powerful module. For AI, that's a massive competitive advantage.
And that plays right into their geographic advantage, which they talk about constantly.
It really does. Their whole pitch about U.S.-based leading-edge manufacturing. It's reinforced by the GPS Act money, that new billion-dollar plan in Ohio.
It's offering a real alternative to Taiwan.
And for the big cloud companies, securing capacity outside of Asia is now a top-level strategic priority. Intel is really the main option for that.
And the scale of this AI market they're targeting is, well, it's almost hard to grasp.
It's staggering. Projections are calling for more than a 10-fold increase in AI data center gigawatts by 2030. It's just an exponential curve of power and hardware needed.
But here's the challenge. To justify all this spending, do they suddenly have to beat NVIDIA at AI or beat TSMC at being a foundry?
That's a great question, and the answer is no. Their strategy only requires them to become a credible, reliable second source.
So if the whole pie is getting 10 times bigger,
Then just capturing a small slice of that new growth is still massive for Intel. They don't need to win everything. They just need to be in the game at scale.
so what products are they banking on? In the data center, it seems to be all about the Xeon 6, the Granite Rapids chip.
It is. And the value proposition there is really compelling. It offers up to 68% savings in total cost of ownership.
TCO. So that's not just the price of the chip.
No, it's the long-term savings on electricity, on cooling. And it uses up to 80% less power than the average server out there today. That gives companies a real economic reason to upgrade now.
And what about the PC market? It's easy to forget about that, but it provides the volume for their factories.
Look, you can't forget the PC. They expect the market to be around 290 million units in 2025. That growth is coming from the Windows 11 refresh cycle and, more importantly, the adoption of the AI PC.
The AI PC, is that just marketing or is it a real thing?
It's becoming very real. It's a device with dedicated silicon, a neural processing unit that can handle AI tasks locally on the device. That requires their new chips, like Lunar Lake and Panther Lake.
Okay, let's shift to the money. This all sounds incredibly expensive. How are they paying for it all?
The cost is mind-boggling. They expect to spend over $27 billion on capital investments in 2025 alone. That's up from $17 billion in 2024.
$27 billion, where's that going?
It's going straight into ramping their most advanced nodes, especially Intel 18A, and building out those advanced packaging facilities we talked about.
But here's the key part. A lot of that spending is de-risked. It's not all their own money.
This is the core of the de-risking argument. In Q3, they added $20 billion in strategic capital to the balance sheet. A huge chunk of that was from the U.S. government.
The CHPS Act funding.
Right, that $8.8 billion agreement with over $5.6 billion in direct funding. That's money that directly reduces the burden on the company.
And it wasn't just the government. They got validation from the industry itself.
Which is arguably even more important for investors. You saw strategic equity investments from companies like NVIDIA and SoftBank.
That's not charity.
Not at all. That's those companies making a bet that Intel will succeed as a partner because they need them to succeed. It spreads the risk around.
And you can see that helping their cash flow, which just hit a really important milestone.
A huge confidence booster. Operating cash flow in Q3 was $2.5 billion, and free cash flow actually turned positive. It hit $7.9 billion.
The first positive quarter in a while.
The first, after several really weak periods. It just gives them so much more flexibility.
And the market definitely noticed. The stock ran up over 120% between August and November. It's pulled back about 7% recently. Is that a warning sign?
I think you have to see that as healthy profit-taking. When a stock moves that fast, people are going to take some money off the table. It's just consolidation, and it often creates a better entry point for people who believe in the long-term story.
So speaking of the long term, what are the key catalysts we need to be watching for in the next few months?
The biggest one, the most critical catalyst, is technical. It's the successful transition of their Intel 18A Foundry node into high-volume production.
And that's expected soon.
As early as December 2025. If they nail this, the whole strategy looks golden. If they stumble here, it's a major problem.
And after that, we have Q4 earnings in January 2026. What's the key thing to look for in that report?
Don't focus too much on the top-line revenue number. We already know it's constrained. Focus on the commentary. Updates on the AI PC ramp, traction for Granite Rapids, and especially any news on new external Foundry customers.
Getting a big name to sign on for 18A would be huge.
Massive. And then in March, look for the next government funding payments. Each one of those is an external confirmation that they're hitting their technical goals.
And what about the more speculative stuff, the rumors that could move the stock?
There are two big ones. First, the Apple Foundry rumors. Could Apple use Intel to diversify its manufacturing away from TSMC? That would be immense.
And the second.
The possibility of them announcing a multi-year supply agreement with one of the big hyperscalers, like a Google or an Amazon,
Locking in a customer like that for years.
would completely de-risk the investment. It would mean they have guaranteed buyers for these new factories before they're even fully built.
Okay, we've talked a lot about the upside. We have to cover the bear case. What's the biggest risk here?
It's pure execution failure. Foundries are brutally capital intensive. Their Q4 guidance still points to low gross margins, around 36.5%, and negative GAAP earnings as they absorb all these costs.
So if they spend all this money but can't get enough customers for the 18A node,
Then the return on that massive investment could be a huge disappointment, and you could be looking at years of weak margins.
and then there's the competition. I mean, NVIDIA and TSMC are not exactly weak players.
They're giants. That's the biggest operational hurdle. But you have to circle back to the de-risking. The strategic funding, the government backing, the geopolitical pressure for a Western supply chain, all of that helps. The market's current valuation probably still assumes they won't fully succeed.
So they don't need a perfect win to see upside.
Exactly. They just need to execute reliably on the plan they've laid out. So when you put it all together, what you have is this immense, though partially de-risked, capital investment balanced against a really compelling multi-year opportunity. It's all driven by AI and the need for Western-based manufacturing. The entire story really boils down to two things: flawlessly executing that 18A node transition and signing up those big-name customers.
Right. But let me leave you with one final thought, something that goes beyond the quarterly numbers. Think about Intel's unique role as the main Western provider of advanced logic manufacturing. In a world with increasing geopolitical tension, what is that strategic national security leverage actually worth to its long-term stability? That's something to think about, completely separate from the normal chip cycle.
It adds a whole new layer to both the risk and the potential reward.
We hope you found this helpful for understanding the Intel turnaround story. Remember to subscribe for future analysis of key companies and market trends.